Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted today to be able to speak to George Ensor of River Mercantile, one of the smartest small and micro cap investors in the UK. So welcome, George.
Thanks very much, Paul. Thanks for having me on.
Yeah, no problems. Now, given the Bank of England is expecting a rip-roaring economy on the back of sort of like a successful UK rollout of vaccination programs, what's your sort of view top level in terms of the outlook for small and micro caps?
So I think the first thing to say is that the UK remains very unloved. So if you look at UK equities versus, rest of world equities, or indeed, other asset classes, bonds, it's pretty attractive. So I think that's a pretty good starting place. I
think you've got, was it the US on about 20 times PE, and the PE for, I think the equivalent one for the UK is about 13 or something crazy.
Yeah, I think they might have moved on a bit since then as well. So
yeah, okay.
Within the UK, and more specifically on small caps, we've seen some great smaller companies' performance from the bottom. But I think it's worth remembering that, go back 2018, 2019, that was pretty tough times for small caps. They underperformed. There was the uncertainty around Brexit. And we've seen them perform quite well with this value cyclicals rally. The Bank of England's come out saying two quarterly, quite a good environment for smaller companies. I think that could potentially play out for a little bit longer. And then, more medium term, well, actually, there's also a pretty good opportunity, in the next 2 quarters, potentially the rest of this year for operational gearing. So where our process perhaps plays in quite well on a bottom-up strategy is, I think, you've had a lot of businesses spend the last 12 months taking cost out, and you're going to go into an environment now where demand gets switched back on very quickly and can potentially rebound back very quickly. I don't think the sell side's, been through that environment before, and you could see some exceptional operational gearing coming through. And I think, if that's going to play out in any part of the market, it potentially plays out strongest in small caps. You've got less coverage, micro caps, some of my micro cap stocks have still got guidance withdrawn from the market and are typically covered by one broker. So where you've got that kind of potential for upside surprises, I think plays out most strongly in small and micro caps. And then finally, medium term, there was an interesting article in the Sunday papers about, inflation coming back. That's been something the City's been talking about for some time now. I'm not all in on that trade, but I think there is the potential with, very easy monetary conditions and expansive fiscal policy to see, higher inflation, higher nominal growth. And I wasn't around the last time that happened, but history shows that, again, that's quite a good environment for smaller companies to outperform. So, with the caveat that we're up a long way from the lows, I think the outlook for small caps is pretty good.
Yeah, and I think also what you're going to get is a lot of brokers have put in some really quite conservative numbers, haven't they, for 2021, 2022. And as you say, you get that operating leverage coming through on small caps, and you've got that discipline on the cost and the cash side, which they've really sort of nailed in from last year. That should really flow through, and you could see some, not only on lower valuations, you presumably could also see sort of like those earnings expectations going up as well.
Yeah, and look, some of that has been discounted. We've seen a big rally in cyclicals, and those are the businesses which are going to be most impacted. But when we talk to companies, they're definitely talking about structural costs coming out rather than cyclical costs coming out, and they've had 12 months to kind of rebase their budgets. And an environment where it's been, perhaps easier to take out costs than many other environments. So I think that's a great opportunity. And, we've taken a position in quite a few UK consumer cyclicals. I think that's one of the parts of the markets that, clearly they're going to have the demand coming back online from about now. And that's an area of the market where you could see that coming through.
Yeah, we'll definitely come on to that in a moment. And you've been really active over the past sort of 6 to 9 months in terms of pivoting into these plays and to these themes. And actually more so than most other portfolios, actually. And you've also gone into sort of like some quite IPOs, some recent flotations, and you seem to have done pretty well out of them. And just as a sort of like a broad brush rule in terms of treating IPOs, because investors don't really get an insight into these sort of flotations. But given the asymmetry of information between the buyers and the sellers for a private company coming onto market to becoming public is usually in the favour of the selling shareholder, how do you actually price that in and treat the risk? And because you've seemed to knock the ball out the park in terms of your IPOs recently. So you've obviously got some secret sauce there.
There's definitely no secret sauce, and I think probably everyone's having the same success on IPOs because in the main they're all going up quite a lot.
Other than Deliveroo.
Other than Deliveroo. I think, with all things, I think you need to be quite cynical because there is that information asymmetry. So cynicism, I think, helps. I think you also need to look at the circumstances. Quite a few businesses come to market to raise money to grow, be them capital intensive businesses or perhaps just very small businesses. Some businesses come to market, they don't actually need capital, they just want the PLC badge that will enable them to win larger clients. And then you've got the other end of the scale, you've got the kind of the PE exit environment where backers selling all of their stock. So you can gauge the opportunity through that. And then we look at lots of IPOs. We definitely don't participate in all of them, and we try and pick the ones that we think fit in best with our philosophy.
Yeah, well, one you've done really well out of is Kooth, and I think it came to market. Was it late last year in September or something? And I think it was IPO'd at 200p, and it trades at 375 at the moment. And it does, as I understand, sort of digital mental health services for the NHS, covering both children and adults. And it's absolutely done brilliantly. And the runway ahead for this thing, presumably, given COVID and social media, certainly for the younger generation, is unstabilizing everybody, never mind youngsters. I mean, how do you actually see that runway ahead for Kooth? Because it seems really exciting business that not many people have ever heard of.
Yeah, so I think you've hit the nail on the head there with the impact that COVID's had. So it has had a material impact on mental health. So what Kooth does is it contracts with the NHS. It contracts actually with the individual CCGs, and they've contracted exclusively with 85% of the NHS CCGs. So they're doing that on a regional basis. They then go into those regions and try and promote interaction for children to interact with their platform, children and young people. And it is then provided as a free service to that end user, and often an anonymous service. So Kooth, you've spoken about the opportunity for them. They currently interact with 1 in 36 children in the areas that they do operate in, and they think the need is 1 in 6. So they've got, I can't remember on the top of my head, something like 15 million of annualized recurring revenue that this contracted revenue with these CCGs. They think just the UK children and young people opportunity is about 85 million. Now they're clearly well placed to take a substantial chunk of that. You've also got to think about the way mental health funding is in the UK or is in England. A large proportion of the money is spent on very acute cases, and kind of as it should be, because we need to help people that have acute mental health challenges. But if you spend a little bit of money on the wider population, then you will stop that evolution of lesser issues to greater issues.
Yeah. And
Kooth's actually doing some work at the moment with London School of Economics to try and prove out the benefits of the spend earlier on in the challenges people have. So instant access on an anonymous basis to support on mental health for children up and down the country is obviously a great thing. And this business is well placed to drive materially higher revenues.
Yeah. I mean, I would certainly point investors to have a good look at this one. I mean, optically, it's trading at about 5.5 times, 6 times EV sales. But the granddaddy of the industry, as I understand, is Teladoc out in the States for telemedicine, which is on about 14 times sales. And my wife actually works at a school, and she rates this service. She actually uses that. She doesn't personally use it, but her children at the schools do. And again, 5 or 6 times sales would seem, for a mature software business, would seem fairly rich, but frankly, the sales grew 50% like for like last year. So I think you're right. Another one, which is again a reopening trade, is Mindgym, and they've got sort of 88% gross margins, sort of like business transformation. And I think they came out with a trading update this morning, actually, and they said that actually the second half has done really well. It's beaten the last year's second halves. What sort of attracted you to that one? It's about 2.5 times sales.
Yeah, so Mindgym provide training services to corporates. Those training services are based on behavioural science. So the crux of behavioural science is that humans don't always behave in a rational way, which I certainly believe, and I think
really?
is sometimes quite obvious. So I think there's an opportunity there. They've worked with a huge percentage of the FTSE 100, and I think a big percentage of the S&P as well. So they're quite well recognised already for what they do. And then if you think of sustainability boards, it is a higher board agenda point now for investment in employees, staff training. And I think these guys are very well placed to capture part of that. But beyond that, I mean, they've grown over the last 5 years at 15% top line growth, which is quite an attractive level of revenues. 88% gross margins, as you say, perfectly capable of delivering 20-25% operating margins, and trades on 2 times EV sales. So that's a relatively attractively valued business. They're making a meaningful investment in digital at the moment, so that's going to depress profitability. But you would expect that to pay back over the next 2 or 3 years.
They were saying actually 3/4 of their business is now digital. It's online, isn't it? Delivery, which must give them more operating leverage. And as you say, I think you and I have a sort of like a GARP value tilt. We don't like overpaying for stuff, but frankly, again, the sort of granddaddy of the UK industry is learning tech. And that's on about 8 times sales. So we're talking of sort of like well over 3 times more in terms of rating. So there must be an opportunity there on a catch-up.
Yeah, and look, I think Learning Tech's also a great business, but they're coming at it from a buy and build, trying to acquire cheaply and improve their businesses. Mindgym's coming at it from a very organic point of view. So, different strategies and coming to the same, I guess, corporate development point from different
There might be a marriage there at some point in time. So moving swiftly on. Now, this was quite an interesting new purchase. I mean, those two are, again, new positions. Another one, Virgin Wines. So when in doubt, bet on Richard Branson, eh?
So I think Richard Branson's nothing to do with it anymore. They pay a small license fee to use the Virgin brand. But what actually struck me when I was doing the research was 2 things. One, it's actually, Virgin Wines obviously do online B2C wine merchant. It's not as competitive as I thought, kind of ahead of reading the research. It's actually quite a consolidated industry, so that's quite attractive.
Who are the main players in? Because I mean, Tesco's do it and all the supermarkets do it. Is it mainly sort of like, I don't know, Majestic and people like that, all the old Majestic? Yeah,
so Majestic, obviously Naked would be the online business that spun out of Majestic. Majestic's clearly online as well. Avery's has got quite a big business. The Wine Society is one of the larger ones in the UK. But you do need to have a level of scale, because these guys aren't just importing wine and selling it. They're actually working with the vineyards to create their own wines, and that's how they create quite a lot of the value. So the lack of competition was interesting, and then the sales retention once they get users into the business is remarkably high. So 90% sales retention. In 2020 they did 120%. That was obviously an exceptional year given COVID. So the combination of those 2 things, this is a business that's delivered profits every year for 10 years, and it came on a 6% free cash flow yield, which, they've just had an exceptional year, but that's a conservative forecast. And I think actually that's, for a business that could compound attractive returns and growth, that's a pretty attractive starting valuation.
And I'm guessing you've already tested the product out, have you?
I've tested the product, yes.
Good man. Now, we mentioned about sort of quality and value tilt. I'll say on the portfolio. And another one which is absolutely seems perfectly placed for this post-COVID world is Instem, which I understand is a software company that does sort of drug discovery and FDA filing sort of registrations and this sort of stuff, but also has got a sort of like a healthcare informatics. And in the pandemic, it increased revenues by 10%, 60% recurring and 75%, sort of like gross margins. And it's still only trading on about 3 times sales. which for an industry that's going gangbuster, healthcare, and for software, and for reopening trade, it seems like it's some of the investors might want to have a look at. I mean, obviously you have, because it's a new position.
Yeah, so we started buying Instem last year, and then they actually did a fundraise to raise some cash for their M&A strategy. So we kind of added to our position through that. It is a great business. They provide software to global pharmaceutical businesses and the research organizations that they outsource quite a lot of the research to. What actually has struck me, and it's not a direct kind of proxy, but we used to own Ideagen in the trust.
Yes.
And it's very similar. It's going through a similar transition into SaaS. Ideagen's now predominantly SaaS, high margins, very high multiple. And, there's a lot of similarities. And, over the next 3 to 5 years, they will transition from 60, I think it is, as you said now, to predominantly recurring revenue. Their margin's 21%. They've said they've got a target to get to 25, but that feels like quite a conservative target for a software business. They have the leading bits of software in all of the verticals they go down into. So, as you say, I think quite reasonably valued for a business that can compound. They've come out with a revenue target for 5 years, which implies double-digit organic growth, CAGR. Margins are going to go up. So, these guys can compound high earnings growth. And again, relatively attractively valued, with the bonus that they're then executing on a value accretive M&A strategy as well.
Good. Yeah. Another one, just moving on, another position that reopening trade that I guess you can test as a customer is Cakebox, which I understand makes nice fancy cakes, cream cakes or something. You sort of like you've been mixing that with a bottle of wine, have you? Or so just to make sure, keeping the management on their toes.
I have definitely tried the Cakebox cakes because they're excellent. They've got a lot of cream in them. But no, it's a great business model, and they don't actually operate the stores, so it's a franchise business model. They've got 150 stores. I think they've got 2 sites that they create the cake mix from, and then they distribute that up and down the country. You'll have seen the logos on the high street. But they make, high margins. They make, I think, a 60% gross margin from selling cake mix to those stores. So limited capital employed, high margins. You've got a store rollout as well. So you've got kind of like for like plus store rollout kind of growth behind it as well. And then actually, one of the things you've got to worry about in these business models is the profitability of the stores, of the franchisees. And the average profitability of a mature site is, I think, 70 or 80,000 pounds of EBITDA. Right. So it's a business that works for both the franchisor and the franchisee. And we bought it last year, mid-teens PE. I think we bought it on. It's re-rated a little bit, but you're paying kind of a market multiple for that business, which I think again is a pretty good opportunity.
Yeah, I mean, to come through the pandemic and see revenues up 16%, it just tells me that they've got a very entrepreneurial culture there, because, with the stores closed, to be able to do 16% growth in revenues is just fabulous, isn't it?
Well, I think they got away with being an essential retailer, which perhaps is a bit generous, because you don't need to have cake, but why not?
You sold it with like a bottle of water or something.
Yeah.
Another one you moved into is DF Capital, which I'd never heard of before, but I understand it does sort of lending, working capital lending to things like basically dealers and renters of mobile homes, caravans, lodges, sort of industrial equipment and boats and stuff like that. So it's quite nichey, but it seems as though they've absolutely knocked the ball out of the park in terms of loan growth over the 6 months, because it's doubled their asset book.
Yeah, so I guess niche is an apt word to describe it. They do pay as sold inventory finance. So if you see an asset on a forecourt, that's typically financed. If you go past an auto dealership, that's typically financed by the OEMs who have got lots of cash, and I think the yields there would be much lower. DF Capital make a 7 to 8% gross yield from financing through either the OEMs of, as you say, caravans and motorhomes and motorbikes and boats, or through the forecourt dealers themselves. What's revolutionized the business is their banking license that they got last year. So they've been able to fund from consumer deposits. So their cost of finance dropped materially, and that they are now a profitable business, or will be by the end of this year. So that transforms the return on equity opportunity. And then they've raised some capital recently, which we participated in, to drive the loan book growth over the next 18 months. And as you say, I think from the trough, it's up over 100%, 150% or something like that. So that part of that is about them being able to turn the taps back on, given they've got that banking license. So it was from a bit of a trough, but they're well placed to continue to grow that loan book.
And what do you think they're sort of like once they grow the margins, the net margins, and they reduce to get the deposits in? What would you think their steady state, say, net margin, also, but more importantly, what's their steady state return on equity likely to be? I mean, it's going to be. It sounds though, it just feels as though decent double digit.
Yeah, so they've already come out saying the net margin is up at 6%. So their gross yield's 6
compared to Lloyd's, it's about 2.6%. So that's a pretty good one.
It's different, yeah. So they're making 7 to 8, paying 1. So you've got 6+ net. At the moment, they've got quite a big cost base in there, so that's not dropping through to a positive return on equity at the moment. But if you look at the forecast, their forecast to get to a 20% return on equity, I think next year or the year after. That will depend on how quickly they grow the loan book, and I would say they're outperforming those expectations at the moment. The difference, with the big high street banks is this trades on a premium to book, so it's on 1.2, 1.3 times book. So there is an element of paying up for that growth opportunity versus the high street banks would be on a discount to book.
Yeah, but presumably if you push the clock forward sort of 3 or 4 years, if they do 20% return on equity, the book value has increased because they've been investing in themselves, and more importantly, you get a re-rating, because if you do 20% return on equity, then I'm just guessing their own cost of capital is probably less than 10% if they've got deposits in there, and therefore a 2 times book would, just by maths, would seem very cheap still.
Yeah, so they're benefiting at the moment from a huge demand in personal savings, and they've been putting. You can go onto their website, but they've been paying, I think, sub 1% for 1 year or 18-month money. So their cost of capital is transformed, as I said, by this banking license.
Yeah. Well, good one for investors to have a look at. Another one was, again, never even heard of, Supreme Imports, which I think is a sort of distributor and supplier of sort of like branded FMCG products, sort of things like batteries, but also it does vaping products and stuff like that. What sort of, given obviously the American absolutely nailed vaping in the state, in the States. How have you viewed that regulatory risk? I mean, it seems as though obviously people smoke in Europe and stuff, and so vaping's a cleaner version of that. But how have you sort of viewed the vaping side?
Yeah, so I guess to start with on the company, this was a business that IPO'd, I think late last year or earlier this year. As you say, legacy of distributing licensed products, and through doing that, they've built up a very strong distribution network. Quite a lot of that, over 50% of that is discount retailers. So they've got this distribution network. They then started building their own brands or acquiring brands to push through that distribution network themselves. And the most successful one they've done to date is 88 Vape, which is their vaping product. They've got 30%, I think, volume market share for that product.
In the UK?
In the UK, they've got 30% share. Yeah. So it's the value vape product, but they've got 30%, or it's estimated to be 30% by volume. The interesting thing about having a market share now in vaping is it's now illegal to advertise vaping in the UK. So the easiest driver of market share is obviously advertising spend, and that's a very difficult thing to do on vaping now. So they've got quite a good first mover advantage position there. The regulation is a challenging one. And I think it's probably why the business came on a kind of 10% free cash flow yield at IPO. Our read on it was the UK is quite mature in its regulation towards vaping. And actually, if you look at what Public Health England is saying, they're saying that vaping is is one of their strategies to move the UK, or to move England, I should say, to smokeless by 2030. So they see the benefits of it. There are obviously risks around, what's happened in the US, and there are risks of more regulation, but we're constantly going to see risks like that in these kind of businesses.
Yeah.
And then they've bought some new, sports nutrition's been one of their latest products that they've bought into to again push those products out through their distribution network.
Good. And then moving out to the reopening trade, I mean, you've also new positions. I mean, all those were other new positions, but it just shows you how active you've been. And I'm absolutely, I tip my hat, because it's very rare you can actually be that active in terms of liquidity in small caps. But, you've sort of like managed to sort of like dip your toe in a number of areas, and again, pivoting into sort of like the consumer sort of reopening. You've got Revolution Bars, City Pub Group, and Joules, all we should have storming second halves.
Yeah, I guess to a certain extent the share prices have read into that second half already, because City Pubs and Joules have re-rated into those expectations. But no, they're very compelling. Revolution Bars and Joules are recovery stocks. City Pubs is actually an asset-backed thesis.
You're another customer of them, aren't you? I can tell.
I could be a customer of all three of those. Yeah, I'm happy to be. So, all three of those we bought in placings last year. They needed to do cash raises to see them through the pandemic.
Yeah.
City Pubs, I think they've got about 50 pubs. Half of those, or just over half of those, are freehold, and we bought into that business on a 60% discount to the freehold backing of those pubs.
Wow!
So we had a great entry point. We paid 50p for the shares there.
Who sold them to you?
Well, that was a placing, so they needed
placing.
capital.
Very well done.
It was new stock, and we added to that position over last summer. I think our average in price is about 55p. So we continue to build that position. But as I said earlier about operational leverage, this is a business that has hugely reduced its cost, and they've come out saying they're going to be more profitable post-pandemic than they were. And I think you could say the same for Revolution Bars and Joules as well. Joules is a great example. Because they've got 125 stores. They've come out saying they're going to take 40 to 60% out of their store costs. And actually, in some instances, they're going to also move from fixed rents to turnover-based rents. So all of a sudden, you're changing the dynamics of what's historically been seen as a very operationally geared industry by moving that rent risk or fixed rent risk to the landlord.
Yeah.
And if they execute on the opportunity to take 40 to 60% out of rents, that's worth about 2% operating margin to Joules. So that's quite a big step up on a business that did 7 pre-crisis.
Yeah.
And then their e-commerce business is also, it's gross margin diluted, but it's net margin accretive. So you've got another driver of net margins for that business. So Revolution Bars is probably the one that has been left behind a bit. They are very indebted.
That's a debt story, isn't it? If they can nail their debt, then effectively they'll get the operating leverage and really sort of power ahead. But frankly, the shares are still they're still very lowly valued, aren't they?
Yeah, so I think if you look historically, they've done about 11 to 15 million of EBITDA per annum. That's the range.
Yeah.
I think they've closed a number of sites through CVAs. So let's take the top end of that number. You're on 4.5 times EV EBITDA. Because of the debt in the business, on a free cash flow to equity, you're saying more like 30% free cash flow to equity. And that, they've got some sites open now, but in time they'll have their whole estate open, and when they are open, they are very cash generative. They recently came out with their interim report, and they've said that solvency is not an issue, liquidity is not an issue. They have got enough capital to see them through. So the risk to that is we have a variant of concern which pushes these dates out, which at the moment feels unlikely, but that is a risk. And if that were to happen, then that's going to impact that business. So more risk, but as you say, still very cheaply valued.
Well, they've got a very young client base, like students and young professionals who are desperate to get out. And I think that you just can't get. I've tried to get, trying to get a table booked at any restaurant. It's impossible, isn't it, at the moment? So just again, and then you've got a bit of sort of like inflation protection as well. You talked about inflation earlier on. You've got you've got SigmaRoc, a new position, and likewise Flowtech Fluidpower, who actually I did see the other day, their non-exec chairman, Roger McDowell, bought £750,000 worth at £1 each. So he's obviously a big believer. But they've got really quite good. Do you want to talk through those two businesses?
Yeah, absolutely. So SigmaRoc, kind of quality cyclical business. For your listeners that know Breeden, it's kind of a mini version of Breeden. So they're
aggregates and concrete.
Yeah, they're doing a construction materials group buy and build.
Yeah.
The key to it is, because your product is quite heavy, it's all about location of your assets. The location of your assets drive the returns of those assets. And I think they've been very successful to date in acquiring assets in good locations. If you look at their annual report that came out quite recently, they've got a great chart in there which shows the organic growth they've delivered from acquiring and improving their assets. And they've got a phenomenal track record. The most recent kind of location they've gone into is Belgium, which the CEO has recently described as like England or like Britain, but without Breeden. So they clearly identify that as a great opportunity. And then the second one was Flowtech Fluidpower, which is a recovery thesis. This is a business that was built through buy and build. And what we often see when these businesses fail to deliver is that the integration behind hasn't been successful. And that certainly happened with Flowtech. So it's had a consistently high gross margin, but the net margin's been a bit of a challenge, and that's because they haven't been able to rationalize the cost base. And that is a process they've gone through in the last 12 months. I think they're just completing on that now. And so, again, another example where we should see net margin post-crisis higher than pre-crisis. Yeah. You've also got this strange dynamic. Typically, trough EPS or very low EPS gets put on a kind of recovery rating, and you get a high rating, low profitability. Well, Flowtech's on a relatively low rating, despite being market leading distribution business. And you can look at some of the larger distribution businesses; they get put on, quite high multiples. And then they've done a job on working capital as well. I think they've taken working capital out of the business for the last 3 years, so returns should improve as well. So another one that's perhaps investors been a bit concerned by the debt, but they've actually paid down debt. They had their numbers last week, I think, and debt was actually paid down last year, which, if you think about that business paying down debt in the year they had last year, that's pretty exceptional.
Yeah, I think they do. They're a distributor of sort of like pneumatics and hydraulic sort of niche parts, aren't they? And I think the key to it is that they can actually bring down their inventory levels. It boosts their return on capital employed, and then you'll just see cash pouring out the business because you've monetized that whole asset base. Plus, you have higher margins, and it's far more efficient.
Yeah, so I think they've probably completed on the taking inventory out. I think, if anything, they now need to build inventory back up. But you're right, that is the exposure.
You shouldn't be telling them that. You're a shareholder.
Well, no, but there are very high-profile supply chain challenges at the moment, and they're also investing in an online offering which they think differentiates them versus all of their peers. And they're looking to take market share. So they've done a brilliant job on working capital. I think that's probably troughed, and they'll look to invest going forwards. But yeah, you're right on the exposure, and it's about half and half MRO, so maintenance and repair, versus OEM exposure.
Yeah, and you've got sort of two final new positions. You've got, I don't know how to pronounce this, Manolete, and then you've got ActiveOps as well. You've bought over the last sort of I don't know how many, you bought double digits the number of new stocks and stuff. But if you could just, as I understand, ActiveOps is a sort of management process automation software platform serving sort of large financial services companies. And is it Manolete is basically an insolvency litigation financing firm?
Yeah. So it sounds like the turnover has been exceptionally high. I would say the turnover has been between 30 and 40%, which is broadly a 3-year holding period. And we've seen quite a lot change. We've also had corporate markets open for the first time in the UK in quite some time. So there's been a lot of activity on that front. I
think you've done perfectly. As I say, you've seen opportunities and you've pivoted really quite quickly. I don't want to put words in your mouth, but it seems to me as an outsider, it looks as though you're searching for alpha rather than leverage beta, and you're trying to actually redeploy capital into more, attractive opportunities, which is really quite difficult in smaller micro caps, particularly your size.
I guess the advantage we've got is, quite well, all of the companies we're investing in have a free float market cap of less than 100 million. So that's not a part of the market which everyone's looking at.
Yeah.
And hopefully, if it's an IPO, if it's a placing, we get the call, or we've already, some of these instances, Cakebox, SigmaRoc, we'd already done some work and started building positions, and then we're an obvious person to come to when they do need to raise capital. So, that's part of the overall thesis of the microcap trust and why we think it's a great opportunity. We did have very low turnover in the trust in 2019. There was very low liquidity in microcaps. And then we have been proactive. We did our return of capital back in January that completed in February. This process we give capital back to shareholders, a forced return of capital to keep the investment trust at the right size to continue investing in these opportunities. So I would say, Tano, we've been busy. I'd say it's stayed in that 30 to 40% range. But on the two companies you asked about, so ActiveOps is a software business that IPO'd in March. So I was quite surprised. But if you told me these big kind of finance insurance businesses that have back offices that are spread across many locations across the world, if you told me there wasn't a go-to bit of software, enterprise level software, for them to use a data approach to planning capacity and utilization, I would be surprised. But that is what has come across from this research. They've got a first mover advantage in what is a very large market. They've won some strong clients. The Australian banks is a part of the market they've been very successful in. They've also shown in the data that they're very successful at winning a client and then expanding within that client and delivering more revenue upside. And the pitch is quite compelling because they say they'll deliver a 15% productivity improvement, and that turns out to be 100% ROI investment for their customer. And they're actually willing to risk, so the training and implementation revenues that come with this software, they're willing to risk those revenues on the back of not guaranteeing, but at the back of assuring those productivity improvements are delivered. If they don't reach a certain threshold, I think it's 12%, the company gets the training and implementation for free. And if they go over 17 or 18%, then they get an additional reward above and beyond what they'd normally charge for training and implementation. You don't see that from many software companies. And I think that really shows that, they've got a great product. So that was ActiveOps.
And then Manolete or Manolete, is it? How do you pronounce it?
I'm not entirely sure. Manolete is how I say it, but
Manolete, I guess. French version, yes, agreed.
So we've got two litigation businesses in the portfolio. We've also got litigation capital management. That's one of our very large holdings, one of our top 10 holdings. We bought Manolete last year. Quite different approaches. So Manolete buys insolvency cases. They typically last 1 year. They've had exceptional IRRs from the cases that they've completed. I mean, like in excess of 100%. I think even in excess of 150%. So with this bit,
just in the argument's sake, would be a company saying a tax dispute with HMRC, or it would be two building contractors, are sort of like a landlord and the developer who are having a punch up over certain things, and the person doesn't want to take the court risk of that, and so they pass it on to effectively an insurer like Manolete.
Yeah, so when a business becomes insolvent, you have claims against that business, and HMRC is normally the largest claimant. And so insolvency practitioners are appointed to try and realise the assets for the claimants. And Manolete purchases the insolvency cases from those practitioners.
Right. Okay. Gotcha.
And they actually go in with they have a revenue share essentially with those insolvency practitioners. So some of the capital goes back to them, and indeed some of the capital will go to HMRC, and then they take the upside reward. So the challenge Manolete have had, I guess, is that they do have quite aggressive accounting policy. Much more so than litigation. Litigation just use cash. Manolete are entitled to, because they have a very short average duration of their cases. But when the cases stop, the P&L kind of slows down materially. So the P&L is very geared to the new cases, and the government has obviously stepped in and prevented quite a few insolvencies over the last 18 months or 12 months. And so the business has suffered from that. But the opportunity still is exactly where it is. I think actually we should see some cash come in while they can't buy cases. So that might prove out the cash generation of the business, which has been one of the market's challenges. LCMs kind of sits on the other side of the fence. They don't buy the cases. They fund the cases.
Yeah, that was the okay. That was more the example I came across, I guess, wasn't it?
Yeah, so that's more of a typical. You know, they do a similar business model to Burford. They have a very different accounting policy to Burford. They just recognise cash out. They don't build in any fair value adjustments. So they've got a very clean balance sheet, which makes it very easy to value. They've also got a phenomenal track record of returns. I think 80% IRR over the last 9 or 10 years. And they've recently launched some funds which helps diversify, I guess, the PLC risk on a per case basis. So they now co-fund with a fund that they run, and they've been quite vocal about them going back to the market and re-raising on that fund.
And how do you value these type of businesses? Is it a price to book, a bit like we talked about before, sort of like the financing business, DF Capital, a bit like that sort of stuff? Is it sort of, if you can lift your return on equity and you can get your cash flow moving, then you get a higher multiple of book?
Yeah, so I think you go down the justified price to book. There are obviously lots of uncertainties about that, because you don't know what the ROE is going to be, and you don't know what the growth is going to be. But you take some sensible assumptions. Now, litigation capital management has traded on a pretty slight premium to book, which, given book is cash, and you can see them realising these cases and collecting the cash. That's a very attractive valuation. Manolete has traded on a kind of, I think it might have been up as high as 4 or 5 times book at its peak, but has come back down.
And what have you been selling then to finance all these purchases? I mean, I see you've lightened your position up, or may have gone out of it totally in Boku, and you've sort of like cut a bit of your Maxcyte position, which again have just been home runs. Yeah,
so Maxcyte remains a large position for us, but we ran a very large position through last year. I think it was 8 or 9% of the fund through most of last year. Following the placing.
You did rather well with that, didn't you?
In April. Well, it was one of those businesses that the market just didn't recognise the progress that was being made. It was loss-making biotech business, so loads of people just put a line straight through that, and often that's going to be the right thing to do. I think there was a shareholder perception issue as well on the register, because one registrar had a big stake at the top of the holding, which looked like someone it wasn't. But they were, from an operational point of view, they were delivering, outperforming, and it was very clear that they were set up for an exceptional 2020. Yeah, and they did this placing at £1.30, I think it was, in April. Last year, and then they started to really deliver through the rest of that year. But 25% revenue CAGR. It was a bit less last year, I think, but long-term revenue CAGR's in place. They've stopped funding the R&D behind Karma, so now a profitable business. And clearly, the market's got very excited about a Nasdaq listing as well, because the US investors will put a different valuation lens on this type of business than we do, which I guess is a bit of a shame that has to happen. Yeah. So Maxcyte, we did take, it's still a large position, but we've taken a lot of profits in that one. Boku remains a position, but again, we have taken profits. It's remarkable. That business listed 2017 at 55, 60p, went up to £1.80, went back down to 45p, and it's back up at 180. And the business genuinely, I don't think it's missed numbers. Well, certainly not underlying. The acquisition of Denal has missed numbers, but the core business, I don't think, has missed numbers. It's essentially the same business, but the valuation has changed by
the rating.
Which is this, we should be active in these kind of names.
Yeah, fintech. I mean, it's 20% like for like growth. I mean, in a down year is just fabulous. No doubt about it. You talked about sort of like just on the corporate governance. An interesting one which just came out actually was another one you own, which is Allergy therapeutics. Now, I did notice, I mean, it's a cheap healthcare stock, which I think does sort of like allergies and sort of like vaccines, hay fever, grass pollen, all that kind of stuff. But I did see the CEO has pledged 1.7 million shares to Banco Santander. I mean, how do you view that? That's really quite unusual nowadays, because I know a lot of CEOs got beaten around for doing something like that. But obviously, he's perfectly entitled to it. He's transparent, so it's not a problem. It just is unusual to see.
Yeah, it is quite unusual to see. I guess quite similar to Maxcyte. It's another business that has delivered exceptionally well. They've had they've had some disappointments on the R&D side, but there's a core very profitable business in there. You know, ex R&D operating margin in the business is 19 or 20%, and it trades on 1x EV sales. So whilst it's not something we really want to see, because it obviously adds in a challenge if the shares go down, you know that he's going to be called on that loan. But, you know, he obviously doesn't feel like he wants to sell stock because the shares are undervalued. It's exciting healthcare business, as you say, on 1x EV sales, very profitable core, and some fantastic growth opportunities. The largest of which is introducing their short course grass PQ grass injection into the US, where they would be the first business to do so, and that's the largest market opportunity for allergies. So it's double-edged, isn't it? We can see why he's doing it, but it does introduce risk.
Yeah, I mean, what usually happens with those arrangements, and I really don't know how it's all sorted, is that if it does sort of like the shares do go down, he doesn't get a decision basically about whether to sell it because it's on margin, and the bank just pulls it onto the market.
I have no insight into it in any way whatsoever, but I expect he's got some personal commitments that he needs to meet, and he sees this as the best way of funding those. And I kind of don't read too much into them.
He's probably doing a bit of DIY or something on his house. You've got some really nice sort of softwares and fintech on the reopening. Alpha FX, Argentex, ULS technology, and Aquis exchange, which is obviously with the Robin Hood style, has been flying. I did see they've actually they recently listed NFT investments, which do, I think, is it non-fungible tokens, which are all the rage at the moment. So you certainly picked some nice little spots there, which are in the process of turning to from acorns into oak trees. And you've also got one which is absolutely flying, which is Alpha FX anyway. Yeah,
so on Aquis, the business, they have bought NEX, which they've renamed Aquis Stock Exchange. The business is actually a pan-European trading exchange. So that's the core business, and they've gone up from, I think, 2 or 3% at the time of the IPO to 5% of pan-European trading volumes. They have a very unique business model, or a unique business model, I should say, which is they've essentially excluded high-frequency traders from operating in their exchange. By doing so, you reduce the toxicity of trading. So under best execution, you're looking for cheap and low toxicity, amongst a few other things. And because they have a subscription-based service, if you get into the top band of trading, the marginal cost of trading is zero, and you've got the lowest toxicity. So I think they'll continue to take market share. They have about 20 or 25% of the share of best liquidity. So, you know, in theory, they should move up to that kind of market share. That's a long way away from where they are now. But they've been very successful in getting the big investment banks to use them, and you know, there's plenty of growth from both existing members using them more, and then potential new members. Some of those other businesses, you know, Alpha FX has got a phenomenal track record of growth. I think something like 60% 6-year organic CAGR in revenue, which is just absolutely mind-blowing.
So it's trading on about 9 or 10 times sales. That was the only thing I thought, you know, with a value tilt or a GARP tilt, you even I mean, admittedly, it's been a home run, and why not continue running it? But it might be something becomes, I suppose it's not an over large position like Maxcyte was.
Yeah, so it's more medium conviction position now.
Yeah.
It has re-rated. What we do see is, as we buy these stocks as microcaps, as they re-rate up through the different market caps, they become investable to a wider audience, and they do re-rate, and that's our opportunity often to reduce our exposure and exit. Alpha FX has re-rated, but they've still got a very, very small share of, they provide bespoke hedging services to SMEs. I think they've still got less than 1% of market share. So this is the classic bank disintermediation trade. Charge the same, charge the same amount, have a much higher service level, and you will that still remains a very big opportunity. So I think there's plenty more growth to go for there. I take your point on a meaningful headline multiple.
Yeah, because Argentex does something similar, not quite, but is on half the valuation at 4 times its sales.
Yeah, and look, all of these businesses can be volatile. I think if you looked at Alpha FX last year, they derated quite a bit. They had a challenge with one of their largest customers, which is actually playing out okay now. They're collecting that capital. So Alpha FX have had some they didn't meet their last guidance. So that drove a derating in the stock. UK small caps is a momentum market that we need to consider conservatism of expectations, and we want to be buying stocks that beat expectations because that tends to be the catalyst for them to re-rate. And the opposite has happened to Argentex. But again, they're taking share from banks. They're providing a very high service level. There's plenty of growth to go for, and as you said, I think it's on 11 or 12 times PE for next year. So there is some growth baked into that, but they're well placed to deliver to that.
And with the housing market flying, USL Tech seem pretty well positioned as well. They do prop tech, don't they? Basically, conveyancing all the way through from end-to-end services. Yeah.
So it's a business that made a disposal last year actually, and made a great disposal, great price on that. They've got a huge amount of cash now. They've got their core business, and I think if you strip out investments for Digital Move, which is this app that they're launching, the business is on kind of single-digit cash-adjusted PE. If you look through a normalized year. So again, a bit like what I've just said about Alpha FX, I think they've got 3% market share for their e-conveyancer solution, which is where they essentially join together a legal professional, a conveyancer, with the consumer through the broker or the lender, which is essentially ULS's customer. They do a rev share with that customer of theirs. And the legal professional pays to be on that platform and uses the platform to do their searches, which are quite high margin. So that's the core business, and they've got low market share there. And as you say, property market's flying, so that should be coming through. But then they've got this digital move opportunity where they're trying to pull an app together where you would use that app for all of your services when you're buying a house. And having recently been through that process, there is a lot of forms to fill in and a lot of services to do. And if you've got an app that interacts with your lawyer, your agent,
speeds it up,
does the utilities, organizes the Sky guy to come around and fix that. Maybe even the lender gets pulled into that ecosystem. You can see how there's multiple ways to monetize that. That's very early days. They've only very, very, very recently launched that. But there's nothing in the numbers or the valuation, in my opinion, for that opportunity.
Well, can you tell them to hurry up? Because my daughters want to buy a house, and that would be perfect for them.
Good luck with that, Paul.
Yeah. And now, just before we sort of wrap up, you have to obviously decide equally what you're going to buy, but you've got to do equally. You've got to also decide about what you're going to not so much sell, but not be in. And you haven't got much exposure to sort of the precious metals, gold guys. Bitcoin you've got no obviously exposure to, and also to the expensive sort of like moonshot renewables or EV side of it. Obviously you've decided that maybe there's better value elsewhere given where the prices are or the long-term trajectory of those assets.
Yeah, I think, we have valuation is a big part of our philosophy. So it's very difficult for us to consider stocks that are pre-revenue or very early stage. We do have some of them, but we try and buy them on very reasonable EV sales multiples.
You don't own Snowflake then, I guess?
We Snowflake didn't quite make it through the process.
The filter.
No. Didn't make it through the filter. We do own some gold companies. We've got Shanta Gold, which I think put it on a sensible gold price. It's on a 25% free cash flow yield, so that's quite attractive. We've got one other gold stock in Brazil, Sarabi. We've also got Capital Drilling, which is a kind of proxy to gold mining in Africa. So we do have some exposure to precious metals. We don't have a lot of exposure to oil and gas. We've got well, we've got two gas businesses, SDX, and we've got diversified as well. Typically, if in microcaps, they tend to be quite high risk investments. They tend to be quite early stage E&Ps. And they've never really been the kind of investments I go for, those kind of, very high risk binary outcome stocks.
Yeah. Okay, just before we wrap it up, you talked about the sort of key risk might be sort of like if we get a nasty variant of COVID coming over, maybe the one Indian or something like that, which puts us back into lockdown. If we just run that one through, given the central banks and the government are all in anyway, do you think they'd come to the rescue again? I mean, it seems as though they'd have to. So you've got that underlying put behind investors, which would, I mean, I don't want to put words in your mouth, but would you see that? Would that see a logical approach, or would you think that it would be a bit more of a painful process this time round?
I think, no idea, but my guess would be they'd have to double down, right? Because you can't put in what they've put in so far. The thing that struck me from last year was I don't know, I'm sure there were a few that they didn't get away, but I didn't come across a single equity placing which wasn't successful. And in fact, most of the ones I was involved in were oversubscribed. Yeah. And that is such a change from the years going into it. 2018, 2019 in small caps, that definitely wasn't the case. So equity investors have rightly said, we're very happy to step in at a certain valuation and fund these businesses. Yeah. And I just think that's a great advert for listed businesses. And there's been a bit of a headwind for listed businesses over the last decade. Yeah. Maybe I should have gone into private VC. But I'm very happy I didn't, and it's been a great advert for listed businesses. And I hope that people that are potentially thinking about the next step for their business, be it sub 100 or small cap, that they do look to public markets, because I think it's a great medium for these businesses.
Yeah. Well, if there is ever a put behind the market, then it means buy the dip, I guess, doesn't it? It's sort of like if we do go through a wobble, then if you see opportunities, you'll be putting your money to work again.
Yeah, I think you've got to try and be opportunistic. Yeah. It wasn't easy putting money to work last April.
No.
But City Pubs and Joules were two of the placements we did in April last year. And you've got to get very comfortable on the balance sheet strength of these businesses going forwards, because you don't really want them to come back for a second raise. Now, a few businesses have. None of the ones we own in microcap, but I think Restaurant Group's come back for a second or maybe even a third placing.
Yeah. And how much cash do you hold as a percentage? Not much, I guess. Then you're fully low. If you return excess cash, by definition, you wouldn't have too much anyway.
Yeah, we don't return excess cash all the time. So when the trust gets too big, we return cash. So the prospectus says between 110 and 125 million. Yeah. We'll return that to 100 million. And we've done that 4 times to date. So we've returned 57 million to date. We originally raised 70 through an IPO and a subsequent placing. So we've returned nearly all the capital raised. We've got an investment trust with a NAV of about 120 million at the moment. Yeah. So we don't typically run high cash balances. And at the end of the last month, cash was about 5 or 6%, I think.
Yeah, mine's only 3.5% now. So, I think we're both on the same sort of page. Anyway, many thanks, George, for your time. Where would be the best place if people want to put some money? I mean, I would strongly recommend that investors have a look at your portfolio, because I was fascinated to see what you've been doing and what the shares are. But if investors want to put some money into the investment trust, how best to do it? Is it best just through a platform, or to contact River Mercantile or website, or yourself directly?
Yeah, so it's a listed company, so the usual platforms should all have the equity on it. Yeah.
Oh, brilliant. Well, again, I think your returns, I was looking at your top quartile. I think you're in the top one consistently for the last sort of like 10 years or 5 years. So very well done on that. And best of luck. And we'll chat, I'm sure, about 6 months' time.
Thanks, Paul. Thanks very much for your time.
Cheers.
Cheers. Thanks.